£804.7 million. That's what the DWP has already paid out in back payments to pensioners. It underpaid for years, sometimes decades, and most of the people still owed that money have no idea they're entitled to it. If you're getting a state pension right now, or you will be soon, 3 separate pay rises have landed this year, and almost everyone I talk to only knows about one of them. Stay with me to the third one, because that's the one that actually pays for itself in under 3 years, and then keeps paying you for the rest of your life. And almost nobody asks for it. I'm Margaret Ellis. I spent close to 20 years working around the pensions advice sector here in the UK, helping ordinary people untangle exactly what they're owed. And here's the thing nobody at the DWP will say out loud. This system runs on what you ask for, not on what you're actually entitled to. Nobody rings you, nobody sends a friendly letter explaining you've been shortchanged. You have to know the right question to ask, and then you have to ask it yourself. There are 3 separate increases sitting in this system right now, and they don't overlap, they don't cancel each other out. They just sit there waiting for the right person to claim them. Let's go through all 3, one at a time. And remember, stick around for the third because that one has a return most savings accounts can't touch. We'll start with the biggest one, and the one almost nobody has heard of. Between January 2021 and March 2025, the DWP went back through old state pension records and found 130,948 cases where people had simply been paid the wrong amount for years, sometimes for over a decade. Not a small clerical slip either. £804.7 million has already gone out the door in corrections. The average payout for married women affected works out at £5,553. For widows, it's higher again, averaging £11,725. And this isn't a one-off check. It's a correction that also lifts the weekly payment permanently for the rest of that person's life. Here's why it happened, and it's a genuinely dry, bureaucratic reason for something that cost real people real money. Under the old state pension rules, which apply to anyone who reached pension age before April 2016, a married woman without a full national insurance record of her own could claim a pension worth 60% of her husband's basic rate. When her husband reached pension age, or when she was widowed, the DWP was supposed to automatically review her payment and lift it. In tens of thousands of cases, that automatic review simply never fired. The computer system was meant to catch it. It didn't. And because nobody at the DWP was chasing these women down to tell them, they just carried on receiving the lower rate, sometimes for 20 years, with absolutely no signal that anything was wrong. Who does this affect? Mainly women who reached state pension age before April 2016, whose payment has always felt a bit low, and they've never quite known why. It also hits widows whose late husband was on the old basic state pension, where the uplift after his death should have happened automatically and didn't. If either of those describes you or your mom, the DWP has said it expects to have every remaining case resolved by the end of March 2027. After that point, this particular correction route effectively winds down. Ring the pension service and ask them directly, has my pension ever been reviewed for entitlement based on my husband's national insurance record? If you're widowed, ask specifically whether inherited entitlement from his record has been applied. If the answer's no or they're not sure, ask them to open a review. 15 minutes on the phone. A correction, if one's owed, changes your income for good. That next one is the one you've probably already heard about, but here's what's surprising. The number most people quote is not the number most people actually get. The triple lock delivered a 4.8% increase to the state pension in April 2026, the biggest earnings-driven rise since 2019. The full new state pension is now £241.30 a week, £12,547.60 a year. That's an extra £575 annually compared with the year before. Sounds simple. But the full rate only applies if you've got 35 qualifying years of national insurance contributions, and a huge number of pensioners don't. Plenty of people are living on well below that full amount because of gaps in their working history, and a 4.8% rise on a smaller weekly figure is obviously a smaller rise in cash terms. Let me tell you about Brian from Coventry. Brian's 63, 2 years off claiming, and he checked his NI record on gov.uk out of curiosity more than anything. He found 4 years in the late 1980s marked as incomplete, years he distinctly remembered working full-time at a factory that closed down not long after. He rang HMRC, dug out an old payslip as evidence, and they investigated. His record was corrected. That single fix will add roughly £27 a week to what he receives when he claims over £1,400 a year for the rest of his retirement. He very nearly didn't bother checking at all because he assumed his record would just be right. So don't assume yours is. Go to gov.uk and check your national insurance record today. If you see years marked incomplete where you know you were working, that's worth a call to HMRC. And on the triple lock itself, next April's rise is still being calculated. Current estimates put it somewhere in the region of 3 to 4%, with the official figure confirmed at the autumn statement in November. Either way, the gap between the headline number in the news and what actually lands in your account depends entirely on how complete your NI record is. Now, here's the one I told you to wait for, because it's the closest thing to a guaranteed investment most people will ever come across. And the deadline on it is real. Voluntary Class 3 national insurance contributions let you fill a gap year in your record. For the 2026-27 tax year, that costs £18.40 a week, £956.80 for a full year. Every gap year you fill adds roughly £6.89 a week to your state pension, permanently, which works out at around £358 extra a year. Do the maths on that, and the £956.80 you paid comes back to you in under 3 years. After that, it's pure additional income every single year for as long as you draw your pension. Over a 20-year retirement, one filled gap year returns well over £7,000. Over 30 years, more than £10,000. But here's what most people don't know before they ring HMRC, and it matters. Not every gap year actually increases your pension if you fill it. If you already have enough qualifying years for the full rate, paying to fill an extra gap adds nothing at all. So before you spend a penny, ring the Future Pension Center and ask them to confirm exactly which gaps in your specific record would increase your weekly pension, and by how much. That call is free and takes about 20 minutes, and it stops you wasting money on a year that makes no difference. And the clock genuinely is ticking here. The standard rule lets you fill gaps going back 6 tax years. That means a gap sitting in 2020-21, fillable today, becomes permanently closed off from the 5th of April 2027. Once that date passes, that particular year is gone for good, no exceptions. So, here's where all this leaves you. The DWP correction exercise for underpaid pensions is expected to be wrapped up by March 2027, and the average payout for widows alone is over £11,500. So if you're a woman on the old system, ring the pension service and ask the specific question about your husband's record. The triple lock gave everyone a headline 4.8% rise this April, but what you actually got depends on your own NI record. So check it on gov.uk and challenge anything marked incomplete that shouldn't be. And voluntary NI contributions can add hundreds of pounds a year to your pension for a payment that pays for itself in under 3 years. But only after the Future Pension Center confirms it's a gap worth filling. And only if you act before April 2027 shuts that door. If you know someone retired or close to it, send them this today. This is the kind of thing that costs someone thousands simply because no one ever mentioned it to them. Subscribe, so the next rule change reaches you before the deadline, not after it. 3 pay rises, 1 deadline that doesn't move, and the only person who can start the conversation is you. I'm Margaret Ellis, and I'll see you in the next one.